Welcome to The Explainer. So today we're diving into this completely fascinating publication from Money Protects Capital Limited, or MPCL. It tackles this massive yet kinda ignored paradox in real estate. Let me ask you, have you ever felt like you're totally asset rich but oddly cash poor? Like you've got this phenomenal piece of UAE real estate. Its value is just climbing and climbing, but your everyday liquidity, well, it doesn't reflect that at all. It's like your money is just locked away in a brick and mortar vault. So picture this hypothetical dream scenario for a sec. What if your property could actually pay you twice? Like, what if you could spin up a brand new second income stream from that exact same property without ever selling it, without any out-of-pocket costs, and keeping 100% of your ownership? I know, it sounds a bit like magic, right? But as we're going to see in this explainer, it's actually just really smart, highly regulated institutional financial engineering. Okay, let's dive right into this with some context. Look, the data is super clear here. Dubai residential property absolutely crushes it when it comes to global rental yields, delivering gross yields between 6.3 and 6.9%. I mean, that is literally double or even triple what you'd see in places like London at 2.7% or New York at around 3%. But here is the massive catch. For the vast majority of owners, that rental yield is where the productivity completely stops. The actual capital value itself, which, let's be honest, often makes up like 90% of your total wealth, it just sits there. It remains completely idle, doing absolutely zero for your monthly cash flow. Here's our roadmap for today. 1. The idle equity problem. 2. The double rental solution. 3. Achieving 12% blended yields. 4. The life cycle of deployment. And 5. 5 layers of protection. Section 1. The idle equity problem. Historically, if you owned unencumbered, mortgage-free real estate in the UAE and you wanted to tap into some liquidity, conventional finance forced you to choose between some pretty awful doors. Door number 1, you sell the asset. Sure, you get your cash, but you completely lose out on future appreciation and wave goodbye to that rental income stream. You're basically exiting a compounding market. Then there's door number 2. You borrow against it. You take out a loan, which gives you cash, but instantly slaps you with a monthly EMI, an equated monthly installment. You've essentially just turned your best productive asset into a monthly household liability. And door number 3? Well, that's just holding it and waiting, leaving all that equity completely trapped. So just how much wealth is actually trapped? Well, the intelligence layer of this system, their proprietary Monidr AI, ran the numbers on modeled owner profiles and found something honestly staggering. A typical unencumbered Dubai property is sitting on 4 to 8 years of household income in pure equity, and it produces zero cash flow. This is a huge deal, especially for seniors hitting their 60s, That's when the asset is at its absolute largest, right when their actual income needs really start to ramp up. Section 2. The double rental solution. All right, so to fix this, MPCL introduced a framework called double rental. It's a regulated equity release architecture that literally converts your dormant property value into a second, capital-protected income stream. And the best part? Your first stream, the rental income, continues entirely untouched. Think of it less like a bunch of random financial products pieced together and more like one single orchestrated operating system for your property wealth. Now, what's really fascinating about this slide is exactly what happens when you turn the system on. First step, 100% ownership is retained. The title deed stays firmly in your name the entire time. Second, your rental stream just keeps flowing. Your tenants and leases are totally unaffected. Third, that brand new second stream of income kicks in. And fourth, and honestly, this is the kicker, there is zero out-of-pocket cost. AED, zero. You literally don't take a single dirham out of your wallet because the existing rent actually services the underlying facility. Section 3. Achieving 12% blended yields. So the absolutely crucial point we need to focus on is this number right here, a 12% blended target yield. By layering this institutional finance, MPCL's ultimate goal is to essentially double the productivity of your asset. Let's break down exactly how the math works to hit this highly desirable target yield. Let's deconstruct this using an AED 1.2 million property as our example. So Stream 1 is your standard rental income. Let's say that's generating a 6% yield, giving you AED 72,000 a year. Now that rent automatically pays for the cost of releasing your dormant equity. Then the equity you release, which can be up to 80% of the property's value, is deployed into AAA-rated, capital-protected structured products. That right there is Stream 2, which also targets a 6% yield, generating another AED 72,000. And because the rent covers the facility cost, every single dirham of Stream 2 is genuinely incremental income.
Combine them, and boom, you achieve a 12% blended yield. That's AED 144,000 yearly on an asset that previously only gave you half that amount.
Section 4, the life cycle of deployments. Let's move to the actual process and see how this builds across 5 really frictionless stages. Stage 1, a digital application via Optimizer AI. There's literally zero paperwork to get started. The Monidr AI instantly pre-screens your eligibility and property value. Stage 2, MPCL and its banking partners structure the equity release up to 80% LTV, that's loan to value, and you only have to sign once. Stage 3 is deployment, where the released equity goes straight into those AAA-rated instruments. Stage 4 just happens automatically. Your rental stream services the facility, so your net cost remains at zero. And finally, Stage 5. Your dual income 5-year cycle officially kicks off, running both streams at the same time. Now, obviously, whenever we talk about releasing equity and generating a 12% blended yield, the absolute first thing any savvy property owner should be asking about is risk, right? Which brings us to Section 5, 5 layers of protection. To address that risk, MPCL has built 5 very deliberate layers of protection between your capital and the market. Layer 1 is the regulatory perimeter. They're strictly supervised by regional regulators like the DFSA and SCA. Layer 2 is legal documentation, meaning everything is governed by standard ISDA master agreements, basically the gold standard globally for derivatives. Layer 3 is instrument quality. Your released equity is completely restricted to AAA-rated, capital-protected products that hold your principal at 100% face value. Layer 4 brings in independent validation through major players like Chromavicang and Baker Tilly. And Layer 5 ensures client integrity with full KYC and AML background screening. The takeaway here? Your capital is shielded by really rigorous institutional compliance at every single step. And this brilliantly illustrates the ultimate value proposition of the entire double rental framework. Your wealth working twice. It's a pretty profound shift in how we look at real estate. You don't have to sell the asset you love. You don't have to take on a stressful monthly loan payment out of your own pocket. And you certainly don't have to leave your equity just sleeping there. By tapping into this structured dual stream architecture, your most valuable asset finally pulls its full weight. So I want to leave you with a provocative thought to ponder today. With a fully regulated framework ready to go right now, capable of unlocking a 12% blended target yield without you giving up ownership or spending a dime out of pocket, how much longer can you honestly afford to let your property equity just sit there doing nothing? If you're curious about what your specific property could generate, that Monidr AI intelligence layer lets you model your exact numbers before you ever even sign a document. It might just be time to wake your wealth up. Thanks for joining me on this explainer, and I'll catch you on the next one.